Well, firstly, I hope everyone survived the trip through security downstairs. I was expecting my passport to be presented, unfortunately just the licence. So I guess firstly, hello and welcome to this evening's presentation, Investment Insights and Opportunities for 2019. My name is Nicholas Pateras, co-founder and director at Wilson Pateras. Wilson Pateras, if any of you in the room have not heard of us, we're an accounting, tax and financial planning business located in Richmond and Brighton. I'd also like to just acknowledge Westpac's participation in tonight's event as a co-host. Westpac is one of Australia's oldest and leading banking institutions, and they've been helping Australians in their banking needs for well over 200 years. Before we commence the presentations, just like to do a quick run through of the proceedings. Our keynote speaker tonight is Roger Montgomery, and he'll be shortly presenting, followed by Wilson Pateras' own Mark Ford, who'll be discussing ALP's proposed tax changes and the money that it could cost you should there be a change in government. This will also be followed by Paul Gersler of the Westpac Bank to discuss lending opportunities for professionals in practice. Tonight's presentation will conclude at approximately 7:30. We should have plenty of time for your questions throughout the evening, and at the conclusion, please network with your fellow attendees. As you know, drinks and canapes are served, so make the most of the catering. And we're also joined tonight in our room with a number of Wilson Pateras representatives, so please feel free to say hello to them and ask any questions that might come from the evening. As a professional in practice, the needs of people in this space we recognise are special, and we have carefully selected tonight's material to address some of these needs. We do believe at Wilson Pateras that to maximise our clients' wealth, our clients should be fully informed around the complexity of financial markets. And tonight's presentation seeks to give insight and answer some of the key questions that relate to the state of financial markets. This includes diversification, geopolitical factors, tax changes, short-term investment markets and how they impact markets in the longer term. Of course, the property correction that is being experienced in parts of Melbourne and Sydney predominantly. And also finally, the unique opportunities in the lending space for professionals. So it's without further ado that I'd like to welcome to the stage Mr. Roger Montgomery. Roger has been quoted by the Australian financial journalist Alan Kohler as one of the nation's smartest and most successful value investors. And Roger is currently the Chief Investment Officer and founder of Montgomery Investment Management. If you haven't heard of Montgomery Investment Management, they're committed to delivering above benchmark returns over the long term and combine 12 decades of experience and unique business and investing insights with a focused approach to selecting quality domestic and global companies. So thank you, and over to you, Roger.
Thank you very much. Well, that's a very big rap to live up to. If I don't, blame Alan. I can give you his email address if you want and get in touch with him. To Wilson Pateras, thank you for the invitation. Thank you for having me speak today. To Westpac, thank you for hosting. I'm looking forward to presenting tonight. And I do hope that the slide comes back up so we can actually talk to something. Here we go. It seems to be on power saver mode at the moment, so it may cut out from time to time. Okay, I know that I've got an allocation of time for Q&A at the end of my talk, but I would prefer it if you would interrupt me throughout the presentation. Reason being, I don't want you to forget the question. Second reason, there was a fantastic study in 1996 in the United States, and scientists established that attendees to workshops and seminars absorb and retain more information if they're awake. So if you're asking questions, you won't nod off. Okay. Okay, I need to do that. There. Here we go. Okay, so we're going to talk very quickly. I'm going to a brief run through about what I think is important to investors. Then we're going to talk a little bit about how we go about achieving that, And then the guts of the presentation really is global and domestic risks and opportunities, and I'll go through a couple of case studies. I know many of you are interested in property, I know many of you are interested in the stock market. I'll do my best to share with you honestly and transparently what I think, but bear in mind, I could be wrong. And I have been wrong. And do you know what? The other thing is, I'll say this, if you disagree, that's okay too. I'm totally comfortable with you disagreeing, simply because every time we buy a share, somebody sold it to us. They absolutely disagree. They are diametrically opposed to our view. When we're buying, they're selling. So I'm totally comfortable. If you have a different view, please shout it out if you want to share it. If you have any value to add to the subject, for example, when we talk about property, if you're a property developer or if you've got an experience you'd like to share, that will enhance the presentation for everybody. So please feel free to shout out and share what you'd like to. Very quickly, in terms of Montgomery's performance in our domestic funds, and this is true for most of our funds, it's important to understand that we're trying to deliver two things. One, we're trying to deliver decent returns, but we're also trying to deliver low volatility. So we're not prepared to generate the kinds of returns that you can see, and the laser pointer isn't working either. So I want to deal with that. Someone got a battery. Sorry. I'm going to stand over here. Can you still hear me up the back?
Yep.
Yeah. Okay. So we're also, in addition to delivering decent returns, we really are focused on delivering smooth returns. We don't want to deliver the sort of volatility that you can see towards the end of that red line there. That's a 19% decline, which then requires a 24% recovery in order to get back to break even. My first client, my first paying client at Montgomery is a billionaire in Australia in the retail space, and I had a pitch deck for him, and I handed him the pitch deck and I said, this is what we're going to go through today and I'd like you to invest with us. And he said, I don't need any of that. All I want to do is go up with everyone else, and I don't want to go down with everyone else. Can you deliver that? And I said, no, I don't think we can, but we'll certainly try. And I'm happy to report that we have done that. With our, that's the Montgomery fund that you saw there. With our Montgomery private fund, it's the bright green line that you can see there. We've achieved that return by keeping 40% of the portfolio in the safety of cash. Now you might think that's a little bit counterintuitive. Why would we want to do that? Because from time to time, while in the long run markets tend to go up, and certainly high quality businesses tend to add value, the reality is that there are periods of dislocation. And we want to have cash to take advantage of very cheap prices because that invariably boosts returns. Now what's important to remember is that cash is a terrible investment over the long run, especially when interest rates are at record lows. It's a terrible investment, but what it is, it's an option over lower prices without an expiry. You can hold it for as long as you like. It is more costly the longer you hold it, but what we want to do is be able to deliver smooth returns. The cash does that. The other thing the cash does gives us the option to buy things when they become very cheap, and from time to time that happens. In fact, more frequently than you might believe. Is that working now? Yeah. Thank you. Great. Thank you. Okay, can you see that red dot up the back? Yep. Okay. Talking about cash, here's a really interesting observation. You've heard of Warren Buffett. You know that he's the chairman of Berkshire Hathaway. This is the cash balance of Berkshire Hathaway going back quarterly to the bottom of the GFC, Q1 2009. Remember, US, they have a calendar year, financial year. So Q1 is March, which was the bottom of the GFC in 2009. What's interesting is that cash has been rising. In fact, it now stands, according to the most recent report, at 132 billion US dollars. To put that in perspective, Warren Buffett last year could have bought any one of the bottom 455 S&P 500 companies outright, and he bought none. Or to put another spin on it, it's 37% of Berkshire Hathaway's portfolio. So it is the single biggest position. So the bloke who is responsible for the epochal fortune being made in investing, and arguably the most successful investor in history, he has most of his portfolio in cash. Yep, go ahead.
Roger, am I correct in saying that Berkshire Hathaway doesn't hand out dividends to their shareholders?
That's exactly right.
And how would we all go not getting any dividends once or twice a year?
Okay.
So that is, I think, how Berkshire Hathaway have been so successful, because of their compounding of dividends
exactly
within
right.
funds.
So what we say to people, if a company, look, I'm not going to have time to go through the mechanics, but if a company generates a very high rate of return on equity, you are actually better off not getting a dividend. You don't want a dividend from a company that can generate a high rate of return on its incremental capital. If a company can get 20% or 30% or 40% return on the retained profits that it's generated, then you don't want the money. What are you going to do with it? You're going to put it in a bank account at 2.5%. You'd rather they keep the money and get 20, 30, 40, 50%. Berkshire Hathaway has compounded, you talked about compounding, Berkshire Hathaway's compounded its returns at circa 20% a year for 50 years. So if you want a dividend, if you want an income, you get to sell a share. And if you want to have a really good year, you sell two. Because the shares are at, what are they now? $300,000, $230,000, $300,000 each now, US. So you just sell a share for your income, if that's what you want to do. In fact, Warren Buffett's logic is, I'll keep the money, because if I pay it all out as dividends, that imposes a tax burden on all the recipients. So I'll keep the money, I'll keep compounding it at 20% a year if I can, for as best I can, and you decide how much tax you want to pay by deciding how many shares to sell. That's how he's done it. But the point is that the single biggest position in the portfolio right now is cash. Okay? Why is that? Because there's not a lot of value in the market. So thinking about our own cash, has that benefited investors? Well, we think so. That's the Montgomery fund. If you draw a horizontal line over to the vertical axis, it intersects at about 85%. What that means is, since the inception of our fund, in any month where the market has gone up, we've captured 85% of that upward movement. Draw a vertical line down to the horizontal axis, and it intersects at about 63%. Meaning in any month where the market has fallen, we've only captured about 63% of the fall. So what's important to note is we're trying to capture more of the upside. We're trying to go up when everyone goes up, and we're trying not to go down when everyone goes down. And I put that down to three things, and that's what I want to share with you tonight. Number one, focusing on quality. What is a quality business? Number two, focusing on prospects. How do you determine prospects? Number three, what is good value? If you're only going to buy good quality when it's cheap, how do you determine value? I want to talk about those three things tonight. And it really, I guess, really added value in the October quarter, you might remember, or the December quarter, when the markets fell a lot. You can see that we didn't fall anywhere near as much, again, satisfying that client's requirement to go up with everyone else, but not to go down as much as everyone else. And if we can piece together quarter after quarter or year after year where we do that, even though we might not get the absolute highest return, we're still going to deliver a palatable profile of returns. What we've learned from our ultra-high net worth investors is they don't really care that much whether we get 9% or 10% or 11 or 12. What they care is just don't lose 50. Okay. So, thinking about how to achieve that, what is quality? Well, I want to give you an example with this glass. We don't think about quality in terms of management. We don't think about quality in terms of proximity to Asia. We don't think about quality that way. We have a very specific definition of what quality is. And it all relates to the return you can get on the incremental capital. So think about this glass being a business or a bank account. Think of it as a bank account. It's a special bank account. It's got $10 million in it, but that's not what makes it special. What makes it special is it generates a 20% interest rate every year. Is anyone interested in that bank account? Who's a socialist? Even if you're a socialist, you want that bank account because you can share it with everyone. Okay? So this is a great bank account. It generates 20% every year. Now what I'm going to do is I'm going to suggest that it's going to keep generating 20% no matter how big that bank account gets. Is that desirable? Well, of course it is. You'd love that bank account. So in year one, it generates $2 million of interest. It plows that interest back in. There's now $12 million. In year two, it generates, it ends up with, what is that, $14.4 million in the third year. So it keeps growing at 20% while always generating 20% on the incremental capital. Now, you can't do that in a bank account. That's incredibly desirable. In fact, if I tried to sell that bank account today, if I auctioned it off tonight, someone here would be willing to pay $40 million for that bank account. Why? because in the first year that $2 million represents a 5% return on their investment. In fact, it's compounding. It's much better than 5% in the long run. But let's say I could sell it for $40 million. What if we change the metrics now, put $100 million in that bank account? I could sell it for $400 million. So let's think about that for a minute. All I need to do is find a business that has $10 million of equity that can grow it to $100 million of equity, all the while generating a 20% return on equity. If I can find a business that does that, I don't need to find anything else. That's all I need to do. And I don't need to worry about Trump, although we all need to worry about Trump. I don't need to worry about Xi Jinping. I don't need to worry about Korea. I don't need to worry about Brexit. I don't need to worry about all those macroeconomic things that make us sound really smart talking about, but really they become irrelevant to this business. And now portfolio. Put together a portfolio of wonderful businesses whose earnings march forward every year over the next 15 or 20 years, you'll do just fine. So what we're trying to find are those quality businesses. A quality business being a business that can generate a high rate of return on incremental capital. That's what we're after. Okay, we'll talk about some businesses that are able to do that tonight. We're also looking for businesses that have very bright prospects. What are bright prospects? Well, there's a couple of ways to present that. Number one, we want a business that can sell more of its stuff in the future than it's selling today. Alternatively, we want a business that can sell the same amount, but it can charge more. In fact, the most valuable competitive advantage that drives a high return on incremental capital is the ability to raise prices even in the face of excess supply, or without a detrimental impact on unit sales volume. So imagine having a business where the only decision you have to make every year is how much to increase prices by, and it has no detrimental impact on your business. You just increase the price every year. That's just, you don't have to employ more people to do it, you don't need more machinery or equipment to do it, you don't need to invest in your brand to do it, you don't need to build relationships to do it, off you go, just raise the price and things are great. That's the most valuable competitive advantage. Now REA has that. Realestate.com.au in Australia has that ability. ARB, the four-wheel drive parts, aftermarket parts supply, has the ability to do that to a lesser extent than REA. BHP does not have the ability to do that. BHP can't do it. If BHP raises the price of iron ore in the face of excess supply, it sells nothing. If it raises the price above the global market price for iron ore, it sells nothing. So BHP doesn't have the characteristic of a quality business that we want. It doesn't have the characteristic of prospects that we want. And if you have a look at the BHP share price, it's the same today as where it was in 2007. Yes, it spun off South 32 as well, so you get that, but REA is giving you a much better return. We'll talk about that as well. The next thing that we're looking for is value. We want to buy these quality businesses when they're trading at a discount to intrinsic value. And the reality is, over the last 3 years, there's been precious little value. There's been a lot of growth and a lot of momentum, and you've seen that in the share prices of companies that generate no profits. They've been going up. But quality businesses, those generating a very high rate of return on equity, they haven't been cheap. They haven't been cheap. We haven't had the opportunity to invest a lot of money in those sorts of businesses, and that's what we'd like to be able to do. So let's look at the economics of BHP and REA very quickly. Forget about the stock market for a minute. I get most enthusiastic about this particular slide, because for many of you, the penny's going to drop and you're going to think, I understand that when I buy a share of a business, I'm not buying a piece of paper that wheels on a screen or a chip. I'm not betting on black or red. I'm buying a piece of a business. I'm not buying just a stock, I'm buying a piece of a business. So let's look at, and I'm hoping you can see these numbers up the back, but I want you to imagine for a moment it's 2007, and I'm asking you to invest $4 billion of your own money. Okay, so reach into your pocket and grab $4 billion. And then what I want you to do is go to your other businesses that you already own and withdraw $32.6 billion of retained earnings from those businesses to kick this business off. So effectively, we're going to invest $37 billion of your money to kick this business off. Now that's not going to be internationally competitive, and we want to be, so we're also going to borrow some money from the bank. We're going to borrow $14.6 billion from the bank. Now you asked me to run that business for you. I run it for a year. After 12 months I come back to you and I report to you a $16.3 billion profit on the $37 billion that you invested. Are you happy? Are you happy with that rate of return? It's pretty good, isn't it? Yeah? It's almost 50%. You're delighted. Do you know what? You're so delighted you say, Roger, you run the business, I'm going on holidays. I'll see you in 10 years' time. I'm going to sail the South Pacific, going to go to Bora Bora, going to go just have a great time, and I'll be back shortly, back in 10 years' time. Come back in 10 years' time, you pull up at the marina, you put the fenders out on the side of the boat, you grab your Louis Vuitton luggage, you put it out on the marina, you call Roger on the phone, you say, come down, I want to know how we're going. And I say to you, well, we've made $7.8 billion this year. And you're thinking to yourself, hang on a sec, 10 years ago, we made 16.3. Now, by the way, I forgot to tell you that before you left, you signed a power of attorney over to me so that I could draw extra capital from you to grow the business if I wanted to. And because you were so happy with our first year's returns, you said, yes, no problem. So now I've reported to you a $7.8 billion profit compared to 16.3 10 years ago. You're starting to ask some questions. But before you ask the first question, I sit you down and say, look, you might need to sit down. Because remember you had put in $37 billion? We have now put in an extra 36 or $37 billion as well. 36 billion. So you've doubled your equity contribution over the last 10 years and you're earning less than half of what you were earning 10 years ago. Does that sound like a good deal? It doesn't sound like a good deal, doesn't it? This is BHP. These are the real numbers from BHP's annual report. Your next question should be, Roger, please tell me, because this is a disaster, please tell me that we've paid off that money that we borrowed from the bank 10 years ago. No, you now owe the banks $50 billion. You actually owe the banks more money. Do you know what you would do in this situation? You probably float the company on the stock market and let mum and dad investors have it, because you don't want it. Compare that or contrast that to REA, and REA has taken more of your equity, there's no doubt about that, but the increase in profits has generated a 1,520% return on every additional dollar you put in, whereas BHP has lost 52 cents in every additional dollar you've put into the business. So you've effectively lost or generated a minus 52% return on the additional capital in BHP, whereas you've made a ton of money on every dollar that you've put into REA. Now, none of this matters if there's no relationship between business performance and share price performance. And I want to be the first one to tell you that in the short term there isn't. There is no correlation between share price performance and business performance. But in the long term there's a very strong correlation. If you have a look at BHP's share price over the last 10 years, it's back to where it was 10 years ago. Yes, it's had this big rally that everyone's talking about because of China's stimulation, but the reality is, if you've been in there for 10 years, you've got that, plus some dividends, plus South 32. Even that's not going to be enough compared to the return that you would have got by buying REA Group at about $6 a share, and it's now at $72 a share over the same period of time. So over the long run, there's a very strong correlation between business performance when we talk about quality, so talking about high rates of return on incremental capital, and in the case of BHP, the return on incremental capital is minus 52%, and in the case of REA, it's 1,520%. So what we're interested in is high rates of return on incremental capital, because what that delivers over the long run is it delivers very good returns. Now, what it doesn't do, you might notice from this chart, is it doesn't preclude share price declines. Even good quality businesses will have periods where the shares come off. And you can see that here and here and here. And during the GFC, REA's share price came off a lot. CSL's share price came off a lot. Cochlear, the same thing. Reece, same thing. 50, 60% share price declines during the GFC, even for high quality businesses. But in the long run, the stock market tends to reflect the earnings power of a business. So what we're interested in is strong earnings power. Okay, so here endeth the lesson in terms of the theory of investing in quality businesses. What I now want to do is turn to markets and where they are. And thanks for indulging me in that. I'm sure you weren't expecting a lesson on investing, but you've now got it. You now probably have all the information you need to sort out your portfolios and work out what's a good quality business and what isn't. What's more important though is where we are today in terms of markets, because often what that can do is give us some perspective or explanatory power for why we can't find value. At the moment, conceptually, we think that the bulk of stocks are expensive. They're on the expensive side of fair value. So imagine a normal distribution curve. Most companies are expensive at the moment. There is a small group of companies that are just ridiculously expensive, and I'm talking about Australian listed companies trading on PEs of 400 times, or 480 times, and 200 times. So there's a collection of companies like that. And there's an even bigger group of companies that make no profit at all, that are trading at extraordinary multiples of revenue. But even in an expensive market, there is always something that might be worth buying. There's usually something that's of good value. For example, a situation that would fall into this category here would be a company that's fallen on temporary hard times, but the market's treating that as if it was permanent. And when markets react to something as if it's permanent and it's only temporary, and I'm quoting Buffett, then that's where an opportunity lies. So example during reporting season might have been Bingo Industries, which is the majority of its revenue comes from demolition and building site waste disposal, those big skips that you see going around the place. They announced that their previous forecast of a 15 to 20% profit growth for 2019 would actually not be achieved and profit would be flat. Share price fell 50% in one day. Now, is that an opportunity? Well, it might be. You'll see in a minute it isn't, not yet. I'll show you a chart to explain why. But there are occasions where short-term events transpire to push share prices down to such an extent that it's an overreaction. And we can take advantage of that as value investors. So even in an expensive market, you'll get opportunities like that all the time. Now, is the market expensive? Well, one way of thinking about that is to look at Robert Shiller's CAPE ratio, which is the cyclically adjusted price to earnings ratio. So this is the S&P 500, the US market. You might be asking, why would we bother looking at the US market? Well, what we've learned at Montgomery is when markets come off, they all come off together. We've actually quantified the variance of returns between markets for 10% declines, 15% declines, and 20% declines. And once you go beyond 20% declines, the variance is almost zero. All markets come off together. So what happens in the US really matters. So turning to the US now, looking at this PE ratio, which takes the inflation-adjusted S&P 500 and compares it to 10-year average earnings, what we find is it's currently not at 29.59. It's currently sitting at about 31 or 31.5 at the moment after the January and February rally in markets. Now you have to go all the way back to 1870, which by the way is before Mawson built that hut down in Antarctica. And there's only 2 occasions where the market was as expensive or more expensive than where it is today. And that is just before the Great Crash in 1929 and just before the tech bubble burst, or the tech wreck, in early 2000, Easter of 2000. So it looks like the market's expensive. Now Robert Shiller, who invented this particular ratio, has actually said this ratio is no good for predicting crashes. But what it is exceptional at is it's exceptional at forecasting the next 10 years average annual return by investing blindly in the index. So if you invest in the S&P 500 at levels above PEs, at PEs above 20 times, for example, you're probably going to end up with a single-digit return compounded over the next 10 years, with dividends reinvested. If you invest below 15, you tend to get a much better return. You tend to get a double-digit return or a high single-digit return. So you're better off investing when it's cheap, when the index is cheap, rather than when it's expensive. But that makes sense because the first rule of investing to understand is the lower the price you pay, the higher your return. The higher the price you pay, the lower your return. So we actually want as investors low prices, not high prices. The lower the price, the higher the return, provided it's a good quality business. Okay, so this is telling us that if we were to buy markets today, we're locking in for a long duration We're locking in a low return. The only question that remains is that return likely to be associated with or accompanied by high volatility or low volatility? Well, we think high volatility, and what I now want to do is go through a couple of things that I think represent catalysts for more volatility in markets. And volatility means risk. Volatility means the possibility of a capital loss. It might be temporary, but it's still the possibility of a capital loss. So one of the things that we know is at the very pointy end of the distribution curve, we've got a lot of very expensive companies that make no money. In fact, there's a tidal wave of unicorns, multi-billion-dollar startups that are looking to IPO this year. And in fact, some of the companies, Lyft, Uber, Postmates, Pinterest, Airbnb, Peloton, Zoom and Slack, none of them make a profit. Lyft is proposing to float next week in the United States. And those of you who don't know Lyft, L-Y-F-T, you know those green hire bikes, those green bikes that you scan and you hop on and go riding wherever you want, or the scooters? You often find them at the top of a hill or in the river. That's where you tend to find them. That company makes no money. It's going to float next week, and the expected valuation, the expected market valuation for a business that makes no money, $24 billion US. Uber is also proposing to float in the second quarter of this year, and Uber is likely to have a valuation of about $100 to $120 billion, and it has never made a dollar's profit since it started in 2009. Not a dollar's profit. Something strange is going on. Something very strange. Either I don't know how to invest, or everybody else is crazy. And I think there's a large element of crazy. Why are all these companies, why do they even exist? If I said to you, here is I haven't got a document, but if I had a prospectus or an information memorandum for sophisticated investors, and I said, here is an opportunity to invest $70 billion this year, and I promise you we won't make a profit for the next 9, 10, 11, 12 years, but we're going to get big. Who's interested? You wouldn't do it. But lots of people have. Why? Because interest rates have been so low that they've been punitive. Quantitative easing and ZIRP, which is zero interest rate policy in the United States, ZIRP, short-term zero interest rates, has meant no one wanted to save. And then quantitative easing has driven the price of bonds up to such an extent that the yield is so low that no one's wanted to invest long-term in bonds either. So find something else for me to invest in where I can make some money. So what have people invested in? They've invested in everything and anything. Record prices in low-digit number plates in New South Wales and Victoria. In fact, number one, New South Wales, sold for $4 million. It's a number plate. If we really do go to autonomous electric vehicles and none of us own cars, that number plate will be worth zero. It will be worth nothing. Low-digit number plates are the record price paid for a work of art ever last year. The record price paid for a post-1980 work of art, a Basquiat. The year before, $110 million US for a post-1980 work of art. Record prices for real estate. Record prices for cars. The highest price ever paid for a British racing car. $22 million US for an Aston Martin, an old Aston Martin. Didn't even look that, I mean, it's a nice car, but not that nice. The highest price paid for any car ever, $60 million US for a Ferrari 250 GT last year. Why are all these record prices happening? Record prices for wine, art, collectible number plates, profitless companies. People put money, people have given money to venture capital funds and private equity funds because they can't get a return in cash. And they've said, look, just go for it. Invest in something that's going to give me a return. Even if it doesn't make money, it doesn't matter. Let's float it and give it to somebody else. Let them lose money on it and we'll just capitalise on the increase in price. That's what's happened. And that's what we're seeing now. But last year, despite the apparent maturity of these businesses and their size and their multi-million-dollar market valuations in the private equity market, 83% of IPOs last year made no money, unprofitable. And that's a record since 1980. So we're seeing a lot of very strange things. Uber lost $865 million last quarter. It's lost $6 billion in the last 2 years, and it's proposing to float at $100 to $120 billion valuation. Look, if I can't emphasise it anymore, if you don't think it's nuts, you can't be convinced. What's happening at the same time is the narrative towards technology companies is shifting, and it's shifting quite dramatically. So previously, these are companies that were going to change the world. By the way, the great thing about new technology is it's easy to sell. Why is new technology so easy to sell? Because there's no metrics associated with it. Therefore, by definition, the sky's the limit. It could be worth anything. We're going to change the world. We're going to decimate taxis all around the world. We're going to replace them with our business. We're not going to make any money, but we're going to decimate that business. What's that worth? It's got to be worth 120 billion, at least, probably more. You see, once you start with new technology, what happens is people's imagination goes wild, they get really excited, and because there's no metrics, people don't know what to compare it to, and so they'll pay anything for it. But the reality of technology is that new technology has always been with us. Think about Carl Benz when he invented that first car. By the way, Carl Benz invented that first car to drive around the park, to promenade. Promenading, you dressed up, you got in the car, and you drove it around a park, and everyone would look at you and say, golly gosh, look at that guy in that car. That's amazing. But his wife, Carl Benz's wife, Bertha, she actually hopped in that car, and she drove it to Mannheim, to another town. She drove it to another town. She was the one who invented motor transport. Carl invented the car, but his wife invented transport, motorised transport. And at that date, that was the late 1800s. Since the late 1800s, what has the car done for humanity? It's changed the course of history, hasn't it? I mean, think about it. Imagine you were back then and you could see what the car was going to do for the world. You'd want to invest in it. The only thing is, in the United States, since the late 1800s, there's been 1,500 car manufacturers. 1,500 car manufacturers in the US. Today, one exists that makes a profit and wasn't bailed out by the government during the GFC, and that's Ford. How could you have possibly picked the winner from that? The same thing with television. The same thing with airlines. Airlines collectively have lost billions of dollars of their shareholders' money, but they have changed the world. And this new technology, it's going to change the world too. It's already changing how we do business and how consumers behave. It is changing the world, but often new technology, the winner of new technology, out of new technology, is the consumer, not necessarily the investor. But of course, every time new technology takes off, people get really excited and they forget those basic principles. So what's happening is the narrative is now changing as well. Governments, social, the populace, they're starting to think that big technology, yes, it has changed the world, but there's also some element that needs to be controlled. And I think Scott Morrison's speech, by the way, last week, after the Christchurch massacre, when he talked about the responsibility of these big platforms for the content that's published on them, I think that was a brilliant speech. But it shows that the narrative is changing towards technology. I wonder in the future if Zuckerberg or Bezos might be on Time magazine's cover as the most hated man in the world, or the most hated men in the world. Who knows? But the narrative is certainly changing at the moment. This is probably the most important chart for the next couple of years. And what this is, it's showing the build-up of bonds on central bank balance sheets around the world. The Bank of Japan, the European Central Bank, the Bank of England, and the US Federal Reserve. And what you'll notice is that up until 2017, they were buying bonds. They were injecting cash into the economy to purchase bonds. Pay cash for bonds, build the bonds on the balance sheet, and cash goes into the financial system and into the economy. That's a good thing. That raises asset prices because nobody wants to invest in bonds. And you can't compete to buy them anyway because the central banks are paying the highest price. But since 2017, what's actually happened is bond purchases are now going into reverse. In fact, quantitative tightening by the Federal Reserve, and some of this is an estimate, some of it's actual, is the reverse of quantitative easing. You can't have it both ways. You can't have declining interest rates and bond purchases lifting asset prices, and now bond sales and interest rate increases lifting asset prices. You don't get it both ways. So I think the next few years is going to be a more volatile period than the last few years. And that's all I'm predicting. I'm not saying we're going to get a crash. I just think there's going to be a lot more volatility, and it's not going to be as easy to simply buy the index and expect to make a handy return. Certainly not a handy return that produces a Sharpe ratio of 9, which meant that the return of the S&P 500 was 9 times higher than the risk or the volatility of the S&P 500 in 2017. That's not normal, and that won't exist going forward. The other risk is that global growth is starting to slow. So we've seen the IMF reduce global growth rates. It doesn't really matter if global growth goes down or up. There's no correlation between the stock market and global growth rates, none whatsoever, not over a 12-month period. But what we do know is that when growth starts to slow, investors start demanding companies cost out. They start demanding that companies reduce costs in order to preserve profits for shareholders. Unfortunately, shareholders in the market tend to be less patient, and companies often aren't able to deliver the cost reductions as quickly as the market expects. Consequently, analysts have to downgrade earnings, and that produces volatility. So that's why I think it's important to understand that growth is slowing. We're not going into a recession necessarily, but growth is slowing. That produces the potential for more volatility. And in fact, we're getting more volatility. We're getting a return to normal rates of volatility. That was not normal through 2017. And when volatility goes up, when risk goes up, PE ratios come down. The price or the premium investors are willing to pay for a dollar of earnings comes down. So even if earnings grow, even if earnings are going up, if volatility accompanies that growing earnings, people aren't willing to pay as much for it. Okay. Australia, and I know you want me to talk about property, or I'm hoping you want to talk about property because I'm about to talk about property. Let me know if I'm going too quickly or too slowly. Before we talk about that though, I just want to highlight this point on this slide. In 2018, top 100 earnings for Australian companies was up 6.8%. Next year, or this year, it's forecast to grow by 3%. However, if you take resources out and financials, take out the banks, earnings are forecast to go down by 3.5%. Remember what I said earlier about the potential for volatility when earnings are going backwards or when growth is going backwards. We've now got the top 100 company earnings going backwards in Australia at the moment, combined with the potential for more volatility and lower PE ratios. That suggests we're probably going to get the opportunity to buy high quality businesses at cheaper prices than we've been allowed to in the recent past. I will say this, we know that consumer confidence has dropped precipitously, and we know that because house prices are falling, we know that consumer behaviour is changing. Belt tightening is something you're going to hear a lot more about over the next 18 months. This is where people focus on their debt because their house price is falling, so they stop spending money in the same way that they've spent money before. A very good friend of mine, Neon Nabrecki, is the dealer principal at Mercedes-Benz Parramatta and Castle Hill, which is the second and third biggest dealerships in New South Wales, and their sales in January were down 46% year on year. So Mercedes-Benz sales are suffering, and in November, nationally, they were down 43%. Ford was off 41% in November last year. Audi off a similar amount, BMW off a similar amount. So big ticket purchases are the first thing that stops. And I'll let you in on a little secret. Internal communications at one of the big banks, I'm not going to talk about Westpac, and it's not Westpac, but internal communications have revealed that loans, housing loan drawdowns for holidays have fallen off a cliff as well, just in the last month. I didn't know people borrowed money to go on holidays. I didn't know that's what people did. And that's ignorant of me. I think that's a really stupid thing to do financially, but apparently people do it. And they're not doing it as much as they were doing it before. Now, what does that mean? What are the implications of that for Flight Centre? What are the implications of that for other travel-related companies? Are they going to travel domestically rather than overseas if they're not borrowing money to travel? Maybe. I don't know. But there's serious implications for this. The sales declines for car dealerships, that suggests to me that there could be a potential to buy some of the car dealerships in Australia. AP Eagers, for example, is listed. There's 3 listed car dealers in Australia. Maybe it gets so bad that people think it's never going to recover, and you get a really cheap share price and you get the opportunity to buy. Okay, in terms of housing, You're not going to be able to see these numbers up the back, so I'll read them out to you. This is from APRA, and I haven't got the December quarter data because when I flew up this morning, I still couldn't find it on their website. So I think it's going to be released this month. I'm certainly hoping it will because it's been delayed. But if you look back to March 2017, the banks were writing $33 billion, roughly, $32 or $33 billion of interest-only loans. Typically, that's the loan taken out by investors. Fast forward to September quarter, and that's dropped by almost 60% to $14.4 billion. You simply can't have house prices going up when there are fewer marginal buyers. So there's simply less people getting finance or taking out finance to buy property. So that's the first thing. Second thing, if you have a look at overseas investors in Australian property or overseas buyers, so Foreign Investment Review Board approved investment in housing for both established and new. Go back to 15-16 and $72 billion of property was being purchased by foreign buyers in Australia. Fast forward to 2017-18, the number's not here, but I can tell you now it's $12 billion. So it's gone from 72 billion to 12 billion. So if you pull the rug out from local investors and pull out the rug from foreign buyers, and by the way, this is a global phenomenon, not just in Australia, it's happening in Toronto, it's happening all over the world. You take those out, the probability of house prices going up disappears. You know, it's almost zero. And then use this chart as a proxy for first-home buyers, and I accept that it's a loose proxy, but here we've got new houses. So think AV Jennings, Metricon, Villaworld, those new homes. We are now at levels that we haven't seen since 2001. We're at 17-year lows in terms of the number of new properties sold. Unsurprisingly, AV Jennings reported a 90% decline in their half-yearly profit in the half just gone. So that's got implications for tradies and the amount of work that they're going to have on over the next 12 months. That's got implications for Nick Scali and the number of couches that they sell over the next 12 months. It's got implications for Jerry Harvey's business. It's got implications for JB Hi-Fi's Good Guys business. So there's serious implications to all of this. And this is the really big one, I think. This red line that you can see that drops quite precipitously here, that's total building approvals annualised. So what we're seeing is approvals for construction of new dwellings has actually plunged significantly from about 280,000 dwellings a year to about 170,000 dwellings a year. Less work for tradies, less work for builders. And those approvals are going to be followed by construction activity because you know you can't build a house or a block of apartments until you get approval. So in the next 12 months, in the next 10 to 12 months, we're going to see a substantial drop in building activity. The construction industry is the third largest employer, employing almost 10% of our workforce in Australia, and 37% of that 10% is in the residential construction space. So some proportion of that workforce is going to have less income. Now I can't tell you precisely what that number is going to be because I don't know yet. But what I do know is it's going to have an effect on their spending, which is going to affect the next largest employer, which is the retail trade sector, 10.5% of the workforce, and consumption is 57% of GDP in Australia. So I reckon it'd be safe to take off about 1% of GDP over the next 12 months. So I think we'll go from something like 3% to 2% or 2.75% to 1.75% over the next 12 months. And I'm not an economist. Okay, so I might be completely wrong on that, but that's my guess. Because I think I know what's happening in the construction space, and I think I know what that's going to have, what the consequences are going to be for the retail spending. In fact, if you drill down to building-related spending, so household goods, furniture, electrical, so think fridges, freezers, couches, and so on. Well, back in October last year, those subsectors of the retail space, they were growing at between 3.5% and 4.5% per annum. Fast forward to January, and they're already tipping over. In the case of electrical goods, down 2.6% year on year. You can cyclically adjust these, you can seasonally adjust them, but the reality is, if your house price is coming down and you've got a big debt, remember Australia has record levels of household debt, you're going to focus on paying down that debt. That's what a credit tightening is. Okay, So big impacts for Beacon Lighting, AV Jennings, Villa World, Nick Scali, Bingo Industries, Bunnings, Harvey Norman. CEOs tend to be really, really optimistic as a species. Right? When I meet with CEOs, when we're going to company briefings and we're interviewing them and analysing their businesses, they tend to be really optimistic. These are the most optimistic things they've got to say about their businesses. Villa World, for example, in the half ending June 30, sold 963 lots. In the half ending December 31st, they only sold 440 lots. People are spending less on property, people are borrowing less to buy property, and consequently they'll spend less on stuff to fit that property out. Okay, a couple of quick case studies and I'll finish up. One of the businesses we own in our global fund, which is really fun to talk about, is Vivendi. You probably don't know Vivendi, but you would know the business that they own, which is the Universal Music Group. The Universal Music Group has the biggest back catalogue of songs in the world. So they have the rights to bands like Pink Floyd, Dire Straits, The Police, and for those of you who are younger and don't like any of those bands, Britney Spears, the Spice Girls, Avicii, you name it, they've got it. The Beatles is included in their lineup. They've got 863 artists and some of the biggest selling artists in the world. Now you would have thought that with music streaming, that's going to completely disrupt their business. They're not going to be able to make as much money from selling a song at 1 cent as they were able when they could sell a CD for $30. Well, that's actually not true. In fact, it's the opposite. If you look at this chart here, the amount of money being spent on digital streaming globally is more than double the amount of money being spent on physical music. So the total aggregate sales of songs is now much higher than it ever was when songs were distributed in physical form. Not only that, but in the old days when you had to release a song via CD, you had to buy a blank CD, you had to laser cut it, then you had to put a package around it, you had to get the artwork designed and pay an artist for that, then you had to make a little booklet with the lyrics of all the songs, you had to slip that in, put it around a plastic cover, wrap it, put it on a pallet, ship it all around the world. Now you don't have to do any of that. In fact, the old way of selling music only created a 10% margin. The new way of selling music is a 60% margin business. In fact, all the marketing, all the distribution is done by Spotify and Apple Music. So if you think about the way this company grows its profits, it's going to grow its revenue. How's it going to grow its revenue? By increasing the number of subscribers, by adding more countries and increasing penetration within existing countries, and people are going to continue spending more and more on digital streaming instead of physical format. How are they going to increase their margin? Well, it's just a lot cheaper. So they're going to sell more at a higher margin. They'll make a lot more money consequently. In fact, the current price of €25 for Vivendi stock implies that they'll make a 25% EBITDA margin on their sales. In actual fact, they've already reported a 37% margin. So the value of the company is much higher than its current trading price. And we think the margin could grow to over 45% because on a per song basis, it's 60%. We think about one domestic example, and I'll finish up on this example. You look at a company like Seek. Seek is, you all know Seek, I'm sure. Its share price is back to where it was 5 years ago. Yet its profits are up 40%. What's really interesting, the reason why people don't like it at the moment, or investors don't like it, is its profits are largely exposed to jobs in Australia. We're at full employment now, so it can only go one way. Employment can only go down. And the economy is slowing. The RBA has reduced its forecast for economic growth. So the market seems to be focused on the Australian business, but it's interesting they're generating EBITDA from China. What's more interesting than that is a completely different picture emerges when you look at revenue. Most of the revenue is now coming from China. So what's going on there? Is that a lower profit business? Is that why they're not making as much profit from China? No, what they're doing is they're reinvesting in the growth of that business, they're reinvesting in their platform, and they're expensing all the reinvestment. So the profit looks smaller in China, but the business is much bigger. And they're investing for the business to be significantly larger. Remember earlier in the presentation I said, think about prospects? The prospects for this business are all in Asia, not in Australia. So the market seems to be getting impatient about the growth that's coming out of China because they're reinvesting. They're not, as you asked earlier, they're not paying out any dividends, they're reinvesting back into future growth. So the value of the business will be much higher in the future from China than the Australian business. I'm going to finish there. I've gone a couple of minutes over time, my apologies for that. Thank you very much for your attention today. I'm happy to take any questions if you've got them, otherwise we can wait to the panel session later on.
Any questions would be great. Yeah, anyone would like to ask a question or two quickly now?
None?
All satisfied?
Yep, there we go.
How do you think about the cannabis business in Australia?
The which business?
The cannabis.
Cannabis business. So Barry Lambert, do you know Barry Lambert? Barry Lambert is the man who was in the news. He was the grandfather of that daughter that illegally brought in the medicinal cannabis to help cure or help alleviate the symptoms that his granddaughter was experiencing. He went to court, he was convicted, but no conviction was recorded. And he promised that he will continue importing that stuff. So he's invested in cannabis. I speak to him regularly about that. What I can't get my head around is the economic model and what that actually looks like. So before we can even work out what profits are going to be generated, I can't work out what the model is yet and what legislation is actually required to allow that business to actually thrive in multiple jurisdictions. So it's very hard to work out. Again, it's like new technology. It's hard to work out who the winner's going to be. I think there's something in it. I just don't know what the size is and what the value is. That's the difficulty. Yeah, another question.
Given the current environment, what do you think of gold as having a percentage in a portfolio? And if you do think it should be there, should it be physical gold or? Yeah, every
year for a bit of fun, I'm going to quote someone else here. Every year for a bit of fun, for Christmas I buy my wife an ounce of gold. So she gets a little black bag, and it's just an ounce of gold. There is absolutely nothing she can do with it. Nothing. And in 100 years' time, my heirs still won't be able to do anything with it. They'll still look at it, they'll fondle it, they'll go, wow, it's heavy, and that's it. I think in 100 years' time, gold is trading where it's trading today. It doesn't have any commercial value. It is speculation on the fear of other people. Gold is a hedge against fear. And I think if you took all the money in the world to buy all the gold, according to, I think it was Charlie Munger, he said if you bought all the gold in the world and melded it down, it would form a cube that would sit inside a baseball infield and be about 63 feet high, 63 feet wide and 63 feet long, and it would just sit there. And in 100 years it'd still be sitting there. But the money that you would spend, which would be over $1 trillion, you could have bought all the real estate in Manhattan. And in 100 years' time, that's going to be generating a lot of rent. Or you could have bought all the arable land in the United States, and that's going to be generating a lot of produce. But the gold will still be sitting there. And so it's fun to buy, and every year Kerry goes, great, what am I going to do with this? Thanks very much. That's my view. I think you'll do better investing in income-producing assets. Gold's not one of those. It is a hedge against fear, and if you can time people's fear, you could do really well speculating on it. And there are people who make money doing that, but it's not investing, it's speculating. Yeah.
Just getting back to property again, what's your thoughts in terms of how long it's going to be until the property markets have stabilised in Australia?
The question is, how long will it take for property markets to stabilise? Well, let me tell you, it's going to be on July the 8th, around 4 p.m. I have no idea. What I don't see is any reason to expect people to want to pay more for property at the moment, and I don't see any reason to expect their ability to pay more at the moment. So in the absence of an ability to pay more, and in the absence of a desire to pay more, I don't see people paying more. And so prices aren't going up, they're still going down. Now, I don't know when that ends, but every fortnight in The Australian I write about something related to investing, and often I talk about property. And I've been warning investors not to buy apartments since the end of 2015. And anyone who's bought since the end of 2015, unless they're really smart, have probably lost money on those apartments. They're going to find it harder to sell for what they paid. Unless they're, there's pockets where you do really well, you get a really neat little development, and there's always exceptions, but in aggregate, you're losing money. So just keep an eye on those articles, because I'll let you know. I'll let you know when I buy.
Time for one more quick one.
One more question.
Just a quick question on, you showed a slide before on the reduction in building approvals and the reduction in construction.
Yes.
Was that table purely bank providers of credit? And if so...
No, it's all it's not loan approvals, it's council approvals,
right.
City approvals. So we're looking beyond the source of funding to the consequences. So we're actually looking at what's being approved. And a lot less is being approved. So there's a lot less activity coming.
On that point, do you have a view on non-bank credit providers in Australia?
Yeah, look, do I have a view on non-bank credit providers in Australia? I think it's healthy for competition to have alternatives. Do you work for Westpac?
Yes.
You do, okay. So I think Westpac's doing a great job. Westpac's doing a great job, but I think it's important for competition. You know, I didn't think that Haynes' recommendations with respect to mortgage broking would get up. I didn't think there was any way that the Labor Party, even though they wanted to adopt the Dutch model and have channel neutrality, so banks would have to charge users for a loan as well as mortgage brokers, I didn't think that would ever get up, because what Labor would effectively have done is converted what is a cost centre for the banks into a revenue stream for the banks. The last thing Labor would have wanted is to be seen as, you know, giving a free kick to billion-dollar making profitable companies. So I never thought that was going to get up. I think it's important to have competition. I think consumers need choice, and I think anything that gives them that choice is probably a good thing. Yep. Provided we don't shaft our dairy producers. Yep.
Thank you, Roger.
Thank you very much. Thanks, guys.
Well, next we have Mark Ford. So Mark is a principal at Wilson Pateras, and he has over 25 years' experience in business services and the professional advice space. Mark's advised on tax and non-tax issues to a wide variety of clients in industries including manufacturing, law, retail, property, medical and professional services. Mark specialises in complex tax structuring and advice, including CGT, GST and stamp duty, as a member of the ICAA and a fellow at the Tax Institute. So Mark will do a short presentation, hoping to give us some insight into some of the proposals that the political opposition has put forward in relation to our taxation system, and how this may affect you in the event that there is a change in government. So welcome to the lectern, Mark.
I must say it's a very hard act to follow Roger, so yeah, brilliant speech by Roger, and I've got a question for him at the very end as well. So Labor franking credit changes is the topic today, but before I get into that, I like to count down there's about 12 different Labor changes that are coming through that I counted the other week, going through it with our accountants at work, and I sort of narrowed it down to my top 5. So for all of these I won't explain today. We've got workshops over the next few weeks to go through all these in great detail. But here's my top 5 just to put it out there for you to give a bit of a flavour of what Labor's proposing. So our first one is a reduction of the CGT discount, which is capital gains tax, from 50% to 25%. So basically what that means in very summarised version is that if you have an asset, you make a gain out of it, instead of half it being tax-free, only 25% of that will be tax-free. So there's a significant cost to investors. The second one, which probably needs no introduction, is that there's be a limitation to negative gearing, and that's had a lot of press in recent times. My number 3 is that lowering the non-concessional contribution amount per annum per person from $100,000 to $75,000. And number 2 is that, again, hasn't had a lot of press on this one, is that the minimum tax rate for distributions from discretionary trust to beneficiaries who are 18 years or over will be a minimum of a 30% flat rate. So if you have an example where you have a discretionary trust, you might distribute to a spouse or to an adult child who's going to university. Usually the first $20,000 is tax-free. In this case, if you do distribute $20,000, there's tax pay of $6,000. So it is another significant impost that Labor is imposing. And the third one, the final one, which we'll talk about today, is the abolition of franking credit refunds. So they're my top 5, and if you want to hear more about it, come and see us over the next few weeks. So let's have a bit of a timeline of change in relation to franking credits and imputation. I won't dwell too long on this one. This is really to give you a bit of a flavour of why things are happening. So pre-1987, we had what they call double taxation. And that is the company would pay tax on their profits. They'll distribute those profits to shareholders as dividends. Shareholders would pay tax on those dividends. But there's no concept of imputation credits or franking credits, all one and the same thing. So which means there's double taxation. So companies will pay tax back in that area for 49%, and shareholders will pay tax at their marginal tax rates without any offset with imputation credits or tax paid by companies. And that was pre-1987. Come 1987, under the Hawke-Keating government, and they said, oh, this isn't really fair, so let's stop this double taxation, it's not fair on investors, and let's put forward an imputation credit system. And so what they did there is saying, okay, company tax is being paid, what we'll do is give you a franking rebate on the tax paid to offset against your tax liability to an amount until your tax liability, best case scenario, will be zero. Any unused franking credits, you'll lose. So basically you either use it or you lose it. And that happened for 13 years between 1987 to 2000. In 2000, we had the Howard and Costello government come through, and that was times when there was large budget surpluses, the mining boom was starting to kick off, and the national income levels were quite high. I said, well, let's get some money back to the people. So let's have a refund of franking credits for those people who have all those unused franking credits I spoke about just before. And at that point in time, just doing some research on this, is that it cost taxpayers at that point in time $550 million to put through that measure. Okay, so we fast forward, that's happened for the last 19 years, and that's been well entrenched into the Australian psyche. And then in recent times, as everybody in this room would be well aware, is that Bill Shorten and the Labor Party said, well, let's abolish the franking credits. Let's not abolish it, sorry, let's abolish the refunds of franking credits because it's unfair. It's going to cost taxpayers, in their estimation, $8 billion. $8 billion per year to get through. And their argument is that they'd rather have that money spent on infrastructure, hospitals, education, all those type of things, as opposed to having these handouts of $8 billion, which puts a strain on the national finances. And that's at the moment. So that just gives you a bit of a flavour in terms of what the timeline was, and sort of a very brief history of what happened. So I move forward and see what is the actual impact. At the top where it's got tax rates, 0%, 15%, right through to 47%. Let's imagine there's a total up there between 0 and 15%. Call it self-managed superannuation funds. Between 34.5 to 47, that would be individual taxpayers like us all in this room. As you work down the table, you go to the two lines which are current and proposed. In a self-managed super fund that is in pension, 0% tax rate. Any franking credit refund they've received over the years, say in 2019, they lodge their return, they're getting $20,000 back. That refund will be lost. That income stream is now gone if Labor gets in and the proposals get through. If the fund is in accumulation mode, which is at 15%, where they're paying tax on their earnings, of course there's some tax to pay because of our taxable income. And franking credits are there to offset against that tax, so there's no tax payable. Any franking credit remaining which is unused will be gone. So as you can see from that table, from 34.5 to 47%, where there's individual taxpayers, they're unaffected. So the Labor policy will not affect people whose tax rates are in excess of 30%. It really affects those taxpaying entities where the tax rate is between 0 and 30%. So who are those taxpayers? It's pretty much self-managed super funds or retirees who are on very low income levels. There is one exemption for pensioners, which is called the pensioner guarantee, and to be eligible for that exemption, you must be receiving a Centrelink pension or an allowance, and that's the only exemption that there is. So as you can see, the major impact on self-managed super funds will be a loss of cash flow and an income stream. So that's basically it in a nutshell. There's very little information in relation to what the policy will be after that. Obviously there's no legislation or other policy documents apart from something on Bill Shorten's website, and that's all that you're going to get. So basically, in very simple terms, is that this be a loss of franking credits. So that's what it is, but what's more important, now that we sort of know what is proposed, we've got to start thinking about, one, having an awareness of it, and two, looking at different strategies that we could possibly implement. I wouldn't be implementing any strategies for a number of reasons, which I'll get to in the next slide. But here's just 3 basic strategies which you may want to consider if you do have self-managed funds and you are affected. And the first one, first and foremost, is review your investment strategy like a super fund and your asset allocation. And your asset allocation may be heavily invested in blue chip shares which pay fully franked dividends. And it's a very heavy weighting to that, and your tax rate in the super funds obviously 0% or 15% when those franking credits are wasted. Is there any other income source that you can have to replace those lost franking credits? Would you invest in hybrids? Would you invest in interest securities? Would you invest in international shares? Would you invest in Vivendi like Roger's favourite stocks? Who knows? But that's a discussion that you have to have with the financial advisor. Please feel welcome to see Don or Sadie in our office. They'll go through all the mechanics of it, but it's one that will come to the fore if or when Labor does win power, if they do win power. The second strategy that I'm doing around is that if you're in pension phase at the moment, 0% tax rate. So why not commute your pension to accumulation? To accumulation, that means your fund will now be taxed at 15%. If you've got enough franking credits, your tax payable in your fund will still be reduced down to 0%. And so therefore, you're not any worse off from a tax point of view. You use those franking credits, but then again, what you have done, there's a number of advantages. One, you're not wasting as many franking credits. Number 2 is that there's no need to make yearly pension payments. We all get to the stage where, okay, you must withdraw X amount out of super, but if you don't need to withdraw that amount of money, why do you need to? Why not retain it in superannuation, preserve your wealth, and let your fund grow in value with the extra cash that it does have? So that's one other strategy. And the final one, which I'll mention, is that one might increase the number of people in the super fund from a minimum of, say, 1 to 2 members up to 6 members. At the moment, it's not legislation has gone through the House of Representatives that the number of people in the self-managed funds can increase to 6 people. Now it's undergoing a Senate inquiry. So if it does become law, and the big question is if it becomes law, and you're able to put more family members into your self-managed fund, and then what you're doing is spreading the amount of franking credits that you have in your self-managed fund across a number of different members. So therefore there's less wastage of franking credits. So that's another strategy that's sort of gaining a bit of ground at the moment. So that's probably the 3 at the moment. There'll be a lot more once legislation comes out if Labor does win, and then there'll be a lot more strategies coming through. But at this stage, they're the ones that are sort of just, I suppose, growing in, just growing at the moment in the media. But let's put everything into perspective for a sec. So all this, we're assuming that all this will happen. But there's a number of things that must happen first before before the policy becomes legislation. The most obvious one is that Labor must win the election. The second one is that Labor must control the House of Representatives. And the third one, which is I think is the most critical one, is that Labor must control the Senate. In the election, in the Senate, there's 76 seats altogether. Only 38 seats of those are up for re-election after re-election come May. Out of those 38 seats, excuse me. So what I'm, I suppose, doing a very quick mathematical calculation, that Labor must win, per my calculations, 25 out of 38 seats to control the Senate. So that is a large amount of number of seats to win. It's a possibility. Is it a probability? I don't know. It depends on the voters. But in likelihood that they don't get the 25 seats, they'll need the support of the crossbenchers to get this over the line. So then it comes down to what crossbenchers will support Labor. And that's something that we don't know. There's been some crossbenchers that have voiced their disapproval about this policy, but it's a wait and see game. So at this stage, if Labor does win government, it may come down, not in the format that they're proposing at the moment, maybe a bit more watered down than that, but at the moment we're pretty much speculating that that will happen. So in a nutshell, that's basically in terms of what the franking credits are. There's very little information out there at the moment, but hopefully that sort of sheds a little bit of light in terms of some major changes that have come through. I mean, some basic strategies that are in place at the moment, and something just to turn your minds to as you go through, and if that does affect you. So as I mentioned at the start, we are holding a number of workshops about not only the franking credit changes, but the other 12 policies that Labor is proposing that will affect a lot of people. So please feel free to speak to Christine of our office and book a time to come in when those workshops are announced. So thank you.
Thanks, Mark, for that. And please feel free to book in. We have had one session already booked out that was due for next week, and we have more sessions that are up for this particular issue, so feel free to contact us. Our final speaker is Paul Gerstler from the Westpac Bank, who's the National Head of Professional and Business Services at Westpac. Paul and his team structure and manage debt funding solutions, including financing the growth of accounting practices, lawyers and other professionals. And Paul will be providing us some insights into the changing landscape as it applies to professionals. So thank you, Paul.
Thank you for that, Nick. I just wanted to firstly thank the people at Wilson Pateras for organising tonight. I've been in Westpac for 8 years, and Wilson Pateras is one of the first new bank clients that a few of us in the room garnered, and we've had a great relationship with Wilson Pateras, and obviously we've got a very engaged client base. I look after, as Nick said, the professional services value proposition for Westpac at the moment, and what we do is pretty much look after the actual firms, their working capital needs, their succession planning, etc., and obviously, particularly for law firms, all their transactional banking needs, which can get very complicated. There's a lot of lawyers in the room today, and I'm surprised no one's actually mentioned in disclaimers, but we're very much willing to have got Sam down the back there who runs a whole portfolio of legal clients. But equally so, we've got two colleagues here today. Jane, who's sitting down there in the back, but smiling. She looks after medical clients, so I think there's a few medical-related clients in the room, and we're happy to talk to you if you need anything. One thing I will say, just pick up on some of Roger's comments today. I'm not too sure, Roger, if I'm going to give my wife an ounce of gold. I just think that's excessive, and I'll leave that for you to deliver that message. I've gone off Uber onto Diddy, so I'm agreeing with you. And the guy from Diddy said they charged me 5%, Uber charged me 30%, so there goes that business model very quickly as far as I can see. Although, having said that, there's all these Uber Eat bags at my house, and I don't order any, so I don't know what's going on with that. I'm also glad to hear that, and so would Chris be glad that you haven't said anything negative about the Surrey Hills, the real Surrey Hills, by the way, Sydney property market. It's booming, isn't it, Chris? Values are going up, so Benson Street is where you want to be buying. But on a more serious note, it's interesting, things have slowed down a little bit, and that's statistical, not necessarily Westpac view. But the funny thing is, speaking to some of my colleagues in Victoria at least, just even in the last month or so, things have been starting to pick up a little bit. And our property guys, we in our commercial segment of Westpac last year lent $5 billion to the commercial property market, and most of that was in the construction side. Has started to pick up a little bit again. Every market's different. So that's probably a good thing for the economy. Population growth in Victoria is still relatively strong. So we're pretty much open business. We've actually been growing staff in Victoria in our broader team, so that's a great thing, particularly for me, if I'm working. So yeah, we are very much open business. We've always got a very positive view of the market in terms of the market we look at. And so that's our feedback from that point of view. So just to clarify too, Roger, we do not have 20% bank accounts. That shows your age. It was a long time ago before we were paying 20% interest on the bank account. So please don't approach Jane, Sam or myself or Daryl down the back on 20% interest rates, because we can probably find it in a different currency, but it won't be the strong. I've got a colleague, a very good looking colleague over there, a beautiful purple tie over there, who also looks after, he's from our private bank, and a lot of you here will have personal banking needs, and I would completely muck it up. In terms of your investment home loans, your home loans, your credit cards, I would completely muck it up. And George over there, he specialises in lawyers, medicos, etc. that need more detailed service, and I think we've got a very big team in Victoria doing that, so feel free to have a chat to George. don't really think there's any questions in the bank. Thank you for not bagging us, Roger. We've had functions here on behalf of the clients, and the guy gets up and bags for us back, so it's always a good thing. So we're ahead there. What's up? Cannabis? No cannabis to the place. Is there anything else? I think we've covered it all off. Yeah, everyone's get out safe, and make sure you give your name tags back, your vouchers, otherwise they'll chase Sam and I tomorrow morning. But we're around there. I think there is more food and drink later on, and please, I bet a few of you on the way in, and it's always enjoyable. But again, thank you to Nick and Christine for organising it. Sorry to ask you a couple of times along the way. You better delete that video actually, because you're not in trouble for that. Maybe that's it. Thank you very much. Enjoy your time. Thank you.
Thank you, Paul, and thank you for everyone for attending tonight. Feel free to have a drink and continue the conversation. There's quite a few members of our team here today, and we look forward to seeing you at our next event shortly. Thank you.